Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we bring to you information that's going to help you make decisions, whether this is the year you go out there and buy that first-time home. I heard some and read some about how a lot of economists, as well as people in the business, and I mean the mortgage business, think that first-time home buyers will make a big, strong comeback in 2023. You know, and a lot of these predictions, I don't know if you make them. Daryl, do you do, what do they call them? Not predictions, but at the beginning of the year, resolutions.
Resolutions, affirmations.
Yeah, do you do, affirmations? Oh, going positive on me. Very nice. Very nice. Do you do them?
Only phony baloney ones.
Yeah, okay, me too. And
play more Genesis this year.
Yeah, oh, okay. Well, for the most part, I'm exactly the same way. And I think a lot of this turning of the clock, going from one year to the next year, is a way by which to sell tickets. And because I'm not a great believer that there's that much difference in December 31st to January 1st, I think what we've been in and are continuing to do is try to sit on inflation, make sure that that stays as low as possible now and continue to drop into the 2% range. That's where America really wants it to be forever. However, rest of the world, nope, don't care. Don't really want to be that interested in it. It's the America First way to look at things. Always has been, by the way, and the former president wasn't the one to usher that in. Americans have always thought that way, whether it be on oil or cars or land or money or anything that you want, you can buy cheap. And thanks to the Walmarts of the world, it has been cheap in America to buy stuff for generations now. So what I'm trying to say is, where are we today with the interest rates? Where are we today with inflation? Has been a trend. The trend is going to continue. And those things that are brought up in order to, I guess, distract you from whatever it is you want to do economically this year. This show, we talk about mortgages. This show, we talk about real estate. We talk about buying a house, right? Simple, buy a house. Is it too expensive? Can't buy it. Is the mortgage too expensive? Can't buy it. Is the mortgage too expensive? The house, there just aren't a lot of them, and the mortgage rates are too expensive. Well, then a lot of people aren't going to buy, and that's really what happened during the last of 2022, really from July on. And you can see it in my bottom line. I work for a mortgage company, Malibu Funding. They sponsor this show as well, but you can just see how really the first half of the year was tremendous. There was a lot of still pent-up demand, and rates were rising, but they weren't at their height at 7.5%. Well, they got there pretty quickly back half of the year, and as a result, the demand for those particular products went out the window, as did the industry. Now, there's a number of different ways you can look at whether the industry is successfully making a comeback as opposed to continuing down the path of, more firings. 343,000 people lost their jobs in the mortgage industry towards the end of the year, and we're seeing some of that still continue. Although, I have to say that of the big banks, and there are a number of them out there, 5, 6, 10, let's say, some are doing really well and continuing to hire, and some aren't doing really well at all and are laying off a lot of people and closing their mortgage divisions to the general public. Let's go through a little bit on that list so you know what I'm talking about. Morgan Stanley, Citi, Chase, they're adding jobs. Bank of America, Brian Moynihan, on layoffs, there will be none. So those banks, those group of people, they're not firing. However, Wells, Goldman, yeah, they are firing. They are laying off. And Wells Fargo, if you're not a client, you can't get a mortgage with them. Why? Because they've stopped doing mortgages with people who weren't their clients, i.e. if you have a bank account with Wells Fargo, yeah, they'll entertain the mortgage with you. But if you're just looking to rate shop and see that they've got a better rate than your particular lender or mortgage banker or mortgage broker, that's who they're going to go with. So that means to you less choice. Less choice is not a good thing, but you know what? There are a number of other lenders out there, especially with a mortgage broker who can shop around and find the best mortgage for you that can really help. Let's get into rates. Let's talk about what those rates are. The 30-year is at 6.17. The high 3 months ago was about 7.5%. So it's really come off that high. The 15-year is at 5.28%. The FHA is at 5.72%. The jumbo is at 5.70%, and the 5/1 ARM is at 6%. The 2-year is at 4.2%, and the 10-year is at 3.5%. That spread is about 7 tenths of a or 70 basis points. That's a big spread, and as we've predicted or shown, or at least agreed with some of the people who say that that kind of spread leads to recession. But what is the recession, I guess, feeling out there in the marketplace, and how is that going to affect you? You want to buy a house, right? Or you want to sell a house and buy something else. Either move up, or maybe you're older and you want to step down, sell that big house, and then buy something in a different city. Where is it exactly that that particular piece is going to fit into your equation? Is there a recession? Is there not a recession? I'm going to say yes, there's going to be a recession, but I am not one. Look, there's a lot of economists out there right now, especially internationally, who are saying, yeah, we're going to have a particular recession, but it's going to be a soft landing. Now, let me get to my notes here, because it's kind of interesting who says what. Okay, Logan Muktashami, who we have quoted here many, many times. He works at Housing Wire, among other places where his particular economic expertise is shared. He's an economist, and again, we've quoted him many times here on the show. Trend growth, inflation has already peaked. What does that mean? That means that where we were, we're not going back there. The Fed has done an excellent job, even though they missed it at the front end. But since then, they have gone skyward with the Fed interest rates, and they're almost at 5%. That's member banks, banks that need to borrow on overnight. What that does is it sucks money out of the system. What does that mean? It means that if there's excess money, which is causing inflation because there's not enough supply, remember, inflation is caused by two things. It's caused by over-demand and not enough supply. Because if you had one, not the other, you probably wouldn't get the kind of inflation we have. But we had both. So what does that mean? The core held up by shelter. That's right. So the core inflation rate at 6.5% overall inflation rate, and the core is probably 0.5 point to 0.75 point lower than that. But the reason it is still high is because of shelter. Now, we're calling shelter housing, right? Either you're going to buy a house or you're going to rent a house. So are the sales prices on houses coming down? Well, there are predictions that it's going to come down in some markets. But there's also predictions that it's not going to come down, and we're going to see a very small percentage of price reduction this year, especially the first 2 quarters. Again, Muktashami, Fed talk tough, but do they do tough? What does that mean? Well, we've seen 4 75 basis point rate hikes plus a 50 basis point rate hike from the Fed in the last 6 Federal Open Market Committee meetings. So what does this mean about the upcoming one, the end of the month, early in February? What it means is they're going to say they're going to keep their eye not only on the ball, but they're going to make sure that they squash, eliminate any thought that the Fed is going to be soft on raising rates. So are we going to see a 50 basis point, 75 basis point, 25 basis point? That's the question here. And Muktashami says he's not quite sure. It really depends on what the economy does. Everybody plays this waiting game about the economy and about raising rates by the Fed. In the meantime, what we've seen is the 30-year and the 10-year have a spread, and that particular spread of 2.5 to 3 points is what they're really focused on. What we want to see is a narrowing of that particular number, and that's what most economists are seeing as the signal to either raise more quickly or not at all. Wage growth is slower. That's particularly true. 3.4 to 3.5 as the 10-year is tested. That's really what's happening out there in the mortgage interest rate market and the overall sense in the marketplace. A lot of people are optimistic this week. let's hope it keeps rolling. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week where we try to bring to you answers to the burning question of when are the rates coming down? Are we going to go into a recession? What's going on with inflation? How does it affect my ability to get a loan? I want to buy this house. Is there any houses available? All these great questions. Now, not only today are we going to give you those answers, but we've been doing it for, I don't know, 8 or 9 years. If you want to go to YouTube and see some of the shows that we've had in the past, give you an idea of what the show's all about, Jeff Barton, the Mortgage Voice, on YouTube. We're also on a number of podcasts, and we also have a terrific website. It is themortgagevoice.com, where you could see the show. You could see the guests that have been on the show. If you want to contact them directly, you can do so through that. Jeff Barton, the Mortgage Voice. Okay, here we go. We have a interesting market, interesting in that I think there's changes are coming, good changes are coming. Maybe interest rates come down a little bit, but the person who knows way more about that, especially the programs that are popular in this particular market, is April Lopez from Nations Direct. She's been on the show many times. Appreciate you coming back. April, how you doing?
I'm doing great, Jeff. How are you?
I'm fine, too. Thank you very much for asking. It's been a challenge, I guess, the last 3 to 6 months, but we see some brightening of some of the issues going on in the mortgage market as we see, I guess, the mortgage rates came down quite a bit from their highs, and we may see some continued de-escalation of interest rates. How's that affecting what you're all doing at Nations, and what are some of the programs over there that are addressing what's going on in the place right now?
Well, great question, Jeff. You know, right now we are starting to see a little bit of the rates coming down slightly.
Right.
Based on, the inflation rates, they are, helping the market a little. They're holding strong. So we've seen, it seems like they react to this consumer price index. So when
Right.
they start talking about that, we see a little fluctuation. So on last Thursday, when they talked about this consumer price index, the Feds came out and said, well, their next talk, they might only raise the interest rates by a quarter. And as you know, that's been significantly low based on what has happened throughout the course of 2022.
Right.
In which case, I think that the reaction will be that interest rates will not go up, and hopefully we have a soft landing to where they just really kind of plateau and maybe have a slight reduction.
Yeah, I think. Go on. I'm sorry.
Oh, I don't think we're going to see some major reduction in the rates, but I think we will see a soft landing to where they'll level off, and then it'll be more, what would that correct terminology be? More, the appetite will be, every consumer's understanding that, okay, we think that this is where we're going to be for the rest of the year, and then they're going to be okay with it. The sales prices have softened a little bit. We're not going to see any, lowering of values, in my opinion, especially in the greater Los Angeles area. The inventory is very low still, so there's still a need for housing. But I think that once the interest rates are back in the, mid to high fives, people feel more comfortable and they're willing to proceed forward in, a home purchase.
Now, some of the programs that you're talking about in order to take advantage, now I think, like you, that we're going to see a real steady year in terms of interest rates in the fives primarily. We're not going to see the huge 3% move that we saw last year, going from, 3% to 6.5%, 7%. Now we're back down to 6%. I think, that is good for the market. What programs are we gearing towards that segment? It's going to take advantage of a 5% to 5.5% rate.
Well, what we're seeing, and it's going to on a purchase market, we're seeing that with sellers that are willing to give some seller credits, we are seeing some great 3-2-1 and 2-1 and 1-1 buy downs. So what does that mean? It means that you have a buyer who qualifies at a 7% interest rate. And if you can get the seller to agree to some seller credits, the lender is now coming out with programs where you qualify at the fully indexed note rate of 7%, but the first year the seller pays a reduction of rate at 6%. The second year, it'll go 4%, then 5%, then 6%. So then you'll have an adjustment and a rate and a payment savings per year based on this buy down program. So that's appetizing to the buyer because they want a lower payment, out of the gate when they purchase a new home. So if it's seller assisted and the seller is willing to take those credits and pay for this buy down, then you have buyers who are happy because they have a lower payment at an introductory rate. And more importantly, the bigger sell is that when we hope to see these rates come down in the near future, say 1 to 2 years, then they can refinance out and have saved those monthly payments over the past 1 or 2 years with this buy down program.
Well, not only that, they may see some appreciation in the house, so they get a double-fold windfall. If the house appreciates in value a certain amount and they're going to be paying less as a result of the refi, that's really a good deal for the buyer.
Absolutely, absolutely. And if there's any extra, so say, for instance, in a year and a half from now, they want to refinance, they've gotten this appreciation in value, any extra money from this rate down program, the lender will do. Most lenders are doing they're doing an escrow hold, so they're going to do a principal reduction so the buyer doesn't lose those credits, because the buyer might say, well, what happens if, we use these seller credits over 2 years, but I sell or I refi in a year and a half,
right?
Am I going to lose the credits? So some of the longstanding lenders are like, no, we'll give you a principal reduction for any unused portion of that seller credit.
Oh, that's a good idea. So there's no early payment kind of penalty then?
None at all, no.
Are you seeing in the marketplace any uptick in mortgage volume at the beginning of the year?
We've seen more calls. So interesting enough, I think a lot of people brace themselves as they said, you know what, the interest rates are high. Come the end of October of 2022, they said, you know what, the holidays are coming. Let's take a break. Let's enjoy the family. Let's recharge. And I think right after the new year, they were eager because we did see a little bit of increase in submissions. So we do see the activity, and it looks hopeful.
Okay. No, the reason I bring that up, just because overall volume in mortgages has been down for, I don't know, for my particular company, 4 to 6 months. And as it's trending downward, any sign that there's a possibility that a particular product or a particular way by which buyers are back in the market is very, very exciting. And so that's why I'm asking. I mean, there's LoanStream has come out with a product for residential buyers to do a commercial loan. I got pitched that the other day, and I just know that everybody's trying to do whatever they can to spark some interest in either their company, their product, or in general in the market. Do you have anything other than these 3-2-1 buy downs that you might be able to tell us about?
Absolutely. We just rolled out a closed-in second. So we have piggyback or standalone seconds. So with this second mortgage program, it's amazing because they're closed-in seconds. This is for borrowers to take advantage of. They have a 2.875-3% interest rate in their first. They want some cash out, but they don't want to refinance that already low interest rate. So we're offering seconds, and they can be amortized anywhere from 10 years all the way up to 30-year amortizations. And They're not HELOCs, so they're not tied to this already high,
right.
LIBOR, right? Well, I guess LIBOR doesn't exist any longer. But
well, it's funny. People are still using the LIBOR. I heard somebody quote it the other day, and I was like, what? I thought that was done. Nothing's done in our business ever.
That is true. So I see some people taking advantage of the seconds, and it's not only a second trustee, but a self-employed borrower can qualify based on bank statements. So they've kind of expanded out the criteria of income qualifying, so it opens up more opportunity for not only your wage earner or your full doc income borrower, but it also helps for the self-employed who want to use bank statements to qualify. Yeah,
and obviously the second, which is a standalone second, doesn't really interfere with the low interest rate you probably have on that first, so that's a good thing too.
Absolutely, absolutely. So that's probably those two products are the new ones that have recently released. And I think, it's still going to be a purchase market.
Right.
So they're just really trying to expand out on, non-QM products, helping more self-employed borrowers to have purchasing power by alternative documentation.
Okay, excellent. Hey, we're up against it. You want to shout out a way by which people might be able to get in touch with you directly if they need some help understanding what you're talking about?
Absolutely. It's April Lopez at Nations Direct, 818-398-1272.
Thank you, April, very much. Once again, always enjoy having you on the show. Thanks.
Thank you.
Thank you very much. That's April Lopez from Nations Direct. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week we come to you, we bring to you some solutions. We talk about problems that are happening either with you, the client, or with the market in general. Obviously, everybody knows what's going on in the market, but your specific niche of what you particularly need in a product in order to get something done, that's a whole different problem, a whole different animal. So Deanna Devereaux is going to join us right now, and she's going to talk about some of the solutions for particular clients in particular areas. You know, it's not always rate is the issue. Sometimes it's the ability to figure out what it is that you need and then finding the correct mortgage to give you. Deanna, how are you?
I am fine. How are you?
I'm fine, thank you. I mean, other than, you know, everybody in January, it just takes a few weeks before they realize they don't have any money and they need some money to pay for whatever it is they just spent last month in order to get going. But I always know that you're busy, you're doing what you're doing. How is your business and what's happening in it?
Wow, it's always pretty busy because we specialize in like the impossible stuff, you know,
Right.
the hard stuff.
Uh-huh.
And so it's going really well. It's just people have to be kind of realistic these days. The market has definitely changed.
Yeah, when you say realistic, you mean cost, right? I mean, that's what you're talking about when you say realistic. You're not going to get it at this, you're going to get it at this. We can do it,
Yes.
but you got to be willing to pay that.
Absolutely. The rates have definitely gone up, even though they're trying to lower here and there, but they've gone up.
Right.
The bottom line, yeah.
Right. Okay. So give us an idea of some of the programs that you are working with your clients. What are some of the things that you think are good problem solvers?
DSCRs are absolutely great for investors. Condo tail loans, non-warrantable condos, asset depletion, 1099s, you name it. Most often, a lot of the investors have problems showing income on taxes. We all know that because everybody writes them off. So, in doing that, all these other non-QM programs are perfect for those borrowers who can show more with bank statements or something like that.
Okay. I was just thinking about something about how your process of helping people when you're interviewing them and when they come to you, what are they? Are they withholding information? Are they forthcoming? Do they fall on their knees and beg you to help them? Because I know that you deal well with real estate agents, you deal well with other mortgage professionals. Certainly the lenders and the people you work with are used to you being able to at least put the deal together. How does that work? How does it start? Give us some ideas as to what you're doing in order to be successful at that.
I just try to get the bottom line out of people. I kind of know when they're holding back.
Right.
You know, from experience. And so I make them tell me the truth. You know, if they're hiding any lates or any liens, or most often, a lot of the times they may have reserves in different places that they don't know that they can use.
I see.
You know, it's the creative process of putting all of it together for them, like in a package. You know, that's the success factor there.
You know,
how to put it together.
Yeah, I think how putting it together, that's the key by which it's the person, not necessarily the rate, that really makes it happen. And I think a lot of borrowers in the non-QM world, they get a bad rap, like there's somehow something wrong with them because they can't get a regular mortgage, which is the furthest from the truth. Most of these people have their own reasons for why they're coming non-QM, and finding somebody that can help them get to where they need to go. Like whether it's, like you were just talking about, DSCR type programs. Explain that a little bit and what that is and what you might be able to do for somebody.
So the DSCR, for example, it goes by its debt covered service ratio.
Right.
So basically it's going by the income of the property rather than the borrower's income. So that provides a lot of relief.
Right.
If they do their research, if the realtor is really good and they do their research, they'll know, kind of what the values are, and that helps the borrower too. And so those have been working really well, especially for properties in Vegas,
right,
and in California as well.
Now, the property you mentioned, Vegas. Okay, let's talk about Vegas a little bit. And that's right down the street from San Bernardino Riverside, where we're currently being heard, the show out there in the Inland Empire, parts of Palm Springs, LA County, Orange County. So being that it's so close, the availability of properties, now we've seen some reduction in prices in Vegas too. Do you find that when you're doing a DSCR that the lender looks at areas if they're declining in value and if that affects the rents you may or may not be able to use? For instance, is it 100% of the rent you can use? Is it 75% in terms of qualifying for the mortgage?
I would say, even though the declining prices have been working in favor, there has been really no problems in, the rentability section. We haven't had too many issues with that. They just take it. It's actually bringing in more investors as the properties have been declining.
Right.
And all of them have been appraising. Actually, we just had one that appraised for higher.
Wow, that's good. Was that a 4-unit building? What is that?
That is a condotel building.
Okay.
Yeah.
I love the condotels.
I know. The issues are these days, though, is that some of them, I think some of the lenders that have moved into the condotel space have not gotten used to what they really are yet.
Right. Right.
Because a lot of the condotels do not have full bedrooms and full kitchens. And some of the guidelines have moved toward that now.
Oh, and that would, well, these are on all non-QM type loans anyway, so it's not like you're looking at a Fannie Mae, Freddie Mac guideline to sell the loan. Who buys these loans, out of curiosity?
Are you meaning?
On the secondary market, after this loan is done and the lender has the loan, do they portfolio it? Do they sell it off? How does that work?
Yeah, they definitely are selling them off. That's what I'm being told.
Oh, I
They
see.
definitely are. Yes.
Yeah, I always
definitely
ask, the reason I ask is because I want to know how funded these particular lenders are, just because if I have a bunch of these things and I'm with them, I don't want to have halfway through the loans them going, hey, you know what, we're at our limit this month, or we don't have any more money for these type of products. So that's happened in past markets, 2008, 9, 10, happened all the time.
That's true. That's very, very true. Haven't heard of that happening too much, outside of certain ones that have closed down, of
Right.
course. But other than that, yeah, that process has been going pretty well, as far as them selling it off. So
Right, okay.
haven't had any money problems there.
No, I like that. I mean, I remember back in the day, of course, this is an old war story, but you would be in the middle of a loan, and it didn't matter what bank you were in those days. They just shut down the whole industry, and you didn't do a loan for 3 weeks. They weren't doing any funding. And this, of course, is during the meltdown, which this particular mild recession will have nothing similar. The credit scores are great. The product's underwritten well. The ability to repay is taken over, the WISHA loan. So I think, for what we see currently coming up, if we see prices in certain cities like Vegas or like Phoenix or like Denver fall, do you have clients that look to those particular places, or do you just pick up clients as they come, like what the lawyer used to call a door lawyer? And I said, what's that? And he said, well, anything comes in the door. I'm like, okay.
Both, actually.
Yeah, okay.
A lot of people are buying in Vegas because the prices are kind of lowering,
Right.
here.
Yeah.
Yeah. And everybody goes to Vegas, they at some point or another. So I've noticed a very big increase here.
Well, we've been out in Las Vegas since 2004. Love Las Vegas itself, and the city has really changed. I mean, the population has probably gone up by at least, pretty close to 1 million. The building that they've done since the crash is really spectacular, and obviously legitimizing Vegas as more than just a party town with the advent of what's going on at UNLV, what's happening with the sports teams, the national sports teams that they bring in. They've really tried to change the nature of it. I like condos out there. I don't know if I can go out there yet. I'm still working. I mean, I look at Vegas for myself as a destination to sort of set up shop, not necessarily just visit all the time. So I really haven't made the move. But, I think there are a lot of people who do buy out there as vacation homes. Is that right?
That's true. Yes, absolutely. As vacation homes, and then they're looking to rent. Absolutely.
Right. Exactly. How are rents out there, by the way?
they're declining.
Yeah.
Surprisingly.
Yeah.
So they were really going up, but yeah, surprisingly they are declining now.
Okay, we are at the end of it. Could you shout out a phone number, an email, some way by which people can get a hold of you? This is Deanna Devereaux, a terrific real estate agent as well as mainly a problem solver in your mortgage world. Deanna, how do they get in touch with you?
818-643-1587 or Deana, DEANA, .malibufunding@gmail.com.
Thanks very much. Thanks for coming on the show. Really appreciate it. You always give a nice, bright smile to me when I'm listening, so thanks very much.
Thank you. Appreciate it.
Okay, you're welcome. That's Deana Devereaux from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we bring to you guests and people and information that helps you make decisions, and making decisions about real estate and mortgages, buying, selling, whether you're going to be in the market, whether you're going to be on the sidelines. This is a very pivotal year for a lot of different people for a lot of different reasons. We're going to go into a recession. It's possible. Are we going to see prices continue to rise? Maybe. Depends on where you live. And can you maintain your job and prove that for the next 30 years? Well, that's what ability to pay is all about. Anyway, like I say, I'm not the one with the answers. The people with the answers are the people that I bring on the show. Michael Chapman of Chapman Real Estate and Finance is with us now, and he's one of those people. Michael, how are you?
Hey, I'm doing well, Jeff. How are you?
I'm fine, thank you. Okay, let's deal with a little bit of the doom and gloom that's out there in the marketplace, especially in the mortgage world, where we saw interest rates climb, I don't know, almost 4% last year. It's dipped down below almost. We're like low sixes, I guess, right now, which is better than mid sevens. But I'm one to believe that we're going to probably vacillate between 5 to 6% all year. And I think those are the type of parameters that we can work with. We've worked with them before, actually, when they were actually terrifically low, when people were so happy if you had a 5.5% mortgage. Now, maybe not so much, but what are your thoughts on that?
Yeah, I think, I think one of the problems is people, and understandably so, they look at history, recent history, and see some of the major economic calamities that we've had, and it just scares them. And with this inflation uptick that we've had over the last year and a half, people are looking back to the 80s, 70s and 80s, like, rates are going to go up to 8, 9, 10, 11, 12%. And then the other thing that people are scared about is the market crashing like it did in 2008. And those two things, people are a lot of people have ducked out, have tuned out, and just too nervous about real estate. But if you look at the data, you look at some parallels and really get into the details of it, it's a lot better than those cases. Interest rates are already coming down from their peaks.
Yep.
The Fed, even though they were behind the 8 ball a little bit,
yep,
they got in front of this a lot faster than they did in the 70s. And counterintuitively, when the Fed raises up interest rates, the overnight rate, that will, not right away, but that fights inflation, and inflation decreases mortgage rates. And we've seen that happen already. And I think your estimate of 5 to 6% is spot on. It's already getting close to that.
Right.
And the other calamity I was talking about was the market crash.
Yep.
Long story short, it's not going to happen because there's no inventory. There's just not enough houses to go around, and when you don't have inventory, when you don't have stuff, it keeps prices up. So there's no sign of your house decreasing by 40% like it did in 2008. So yeah, circling back to the interest rates, though, the really good tool that loan officers are using right now to get buyers in is called a buy down. Okay,
right.
It's a temporary buy down. It's a very effective way to get your payment what you were thinking it would have been like 2 years ago. Okay, so how it works is you're going to temporarily buy the rate down 2 points, 2%. So let's say it's at 5.5 right now, and you do a 2-1 buy down, then it's going to be 3.5% for the first 12 months, then 4.5% for the next 12 months, then 5.5% after 2 years. So, and it's actually even better than that, because how it works is that buy down money is going to go into an escrow account, buys your rate down on a monthly basis. So if you refinance and there's no prepay penalty to refinance, that money that you use for the buy down will go to lower your loan balance, go to a principal reduction. So you really can have your cake and eat it too with this kind of tool.
Now, the cooperation of the seller, any resistance?
Yeah, typically I actually have one where a buyer and seller are splitting it.
Okay.
But yes, right now, because the market slowed down, it's case by case, but sellers are more willing to negotiate to get some offers in and open up escrow. So
do you find
that
that
with your realtor.
Is the price artificially inflated in order to cover the cost?
No, I mean it depends on that's a discussion that your agents have to have. They have to look at comparable data and make sure that it's going to appraise for that that offer. So, for example, let's say there's an offer for $500,000, okay, and to do a 2-1 buy down, it's going to be about $11,000 on that purchase price. So the agents get together and they say, look, what's this house going to appraise for? Is it 500, 510, 520?
Right. And
then you can say, let's set it to 510 if it's worth that. And then the seller gets the proceeds that they want, and they do a $10,000 concession for the 2-1 buy down, and then everyone's happy.
Right. And is the actual lender happy with that? As long as it appraises, I guess it doesn't matter, right?
Yeah, exactly. As long as and look, with technology now, these appraisals are a lot more scientific than they used to be.
Right.
There's so much data. I mean, with our refi boom, you could often get an appraisal waiver because there's so much data in the system. So you can't really artificially inflate the value of a house.
No, and I think right what you said earlier about 2008. This is another one of the issues that came up at that time that doesn't exist anymore. I mean, the ability to be able to manipulate appraisal values. That's just you can't do that. No,
and there's so many checks and balances now where it's just not going to happen. So it's not something that a buyer should be concerned about. The agents do. The agents have to have they have to have a conversation and say, look, we don't want this to come in under. Is this gonna work? So it's case by case, but more often than not, to get offers in, and a lot of times, sellers will underprice their listing to get more offers in.
Right.
And in that case, you could go up a little bit higher. So.
Yeah, that's interesting. It's very interesting how the market is played. Are you finding that your particular clients looking for a mortgage are more, I guess, able to see what you're talking about in terms of creativity in the marketplace, whether it be with this type of loan or a DSCR or some other kinds of products?
I've been utilizing this tool that I do a little video presentation with my clients. It's called the total cost analysis.
Okay. And
it kind of shows them a side-by-side comparison of all the parameters of the mortgage, the cost, the monthly payments broken down, PITI, principal, interest, taxes, and insurance, all that stuff broken down, and it's really easy for them to look at a compare and contrast, like what the 30-year fix look like versus a 2-1 buy down 30-year fix, or maybe they're looking at a 7-1 ARM compared to a 30-year fix, and they can just kind of see all these different scenarios, and then with a conversation with me and their family, just figure out what's the best path for them to go on.
Oh, that's excellent. Do you have a way by which people can, I guess, either see that or see a demonstration of it or get in touch with you to be able to?
Absolutely. I'll forward. If you text my number, I'll send you my email address, and then we can connect that way. It's sent out over email. The little link for the total cost analysis, and yeah, it takes me 2 minutes to set this thing up, and it's a really good way just to feel like you're not getting the loan officer isn't pushing some kind of crafty product on them. It's just showing you the different options you have to get into a house.
Well, I think anybody in the marketplace who is looking is looking around for the best. Obviously, comparisons of a number of product in an easy way to do it is the way to do it, with no
Correct.
pressure, you know?
Yep.
So how would they get in touch with you in order to do that?
Well, my number is 619-888-3049. If you text me or call me, shoot me a text. I'll reply back with my email address, and then we'll go from there. You know, I need to get a couple of pieces of information, and it doesn't. With doing this, it can be like if you're not comfortable giving out a lot of personal information yet, I just need like a couple of parameters.
Right.
And if you know that you have good credit, you can say, yeah, I've got a good 700-ish credit score, and I can put something together from there. Then once you're comfortable, then we can get more details.
Excellent. Hey, Michael, thanks very much for coming on the show. Sorry I cut you off a few times, but I just keep wanting to jump in every time you spark
No,
out.
look, I'm excited about this year.
Right.
I know a lot of people have ducked out, but I think it's going to be a lot better in real estate. Look, I mean, there's a lot of headwinds economically. I think you're right. We're probably going to go into a recession, but there's a lot of value, and if you can talk with the right people, you can really do yourself well by getting into a house this year.
Thank you, Michael. Thanks for coming on the show. I really appreciate it.
All right, Jeff. Appreciate it too.
Thank you. That's Michael Chapman, Chapman Real Estate and Mortgages. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Thanks for hanging out with us on a Saturday or Sunday or wherever you're listening to us. We're available on a lot of different places. YouTube is one of our biggest hits. As a matter of fact, if you go there, it's Jeff Barton, the mortgage voice. Tune in. You can see this show, last week's show, archive shows, hundreds of shows there, and you can see kind of the trend of what's happening both nationally, locally, and certainly in my KCAA listening area. I want to thank those people over there, Fred and all the people, Mark, who work there. They bring us to a wide variety of people who are interested in the show, and we also know that they bring us to a number of different podcasts. Do you have that list of that podcast there, Daryl?
I sure do, Jeff. It's an Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
Excellent. Podclips.io. I always send people there. Why? Because it's a central location, especially if you're older like myself and really can't hunt around for podcasts. If I see one, I'll listen, but I don't really know where to go and how to do it. Okay? Well, this is one place you can go, podclips.io. They have a smattering plus a plethora. How about that? 2 words I know nothing about. But if you want to know about finance, if you want to know about health, if you want to know about politics, if you want to know about any number of different topics that you can gain, go to podclips.io. Great place, great people, and I think they're still producing a number of shows on a weekly basis. Is that right?
That is correct, and some of them are done right here in the studio.
Excellent. Okay, very good. That's Daryl, who is our not only engineer but producer for the show. I want to thank him always for helping me out when I get stuck and need a helping hand to know what I'm talking about. Okay, so a few things extra in what's going on in the real estate market. Real estate is probably the most important element of what's going on, not only in the inflation number, but also in the availability of housing. Housing kind of leads the pack when it comes to coming out of recessions, going into recessions. What we've got right now is an unsure real estate market nationally. Pockets of areas such as, do I have it? Yes, I do. I don't know where it is, but it's here somewhere. Let's see, Seattle, Austin, Denver. These places are going to see some real estate rollback in terms of the prices. Some of the prices have already gone up to 10% lower than what they were last year. And one of the things in lowering prices is that you get, when a house comes online, when a house comes up for sale, you'll see the actual listing price be less than it was last year. That's a good thing. Also, you're going to see a great number of concessions by the seller. 63%. Let's see, where is it? I'll get it in 1 second. It's 42% concessions versus 30% historical. Okay, what is a concession? When a seller says, okay, I will give you credit towards your closing costs, that's a concession. And that's what we're talking about here. So 42% of the houses on the market last year that sold with concessions. That tells you that we're switching from a seller's market to a buyer's market. Now, there are going to be, as I just mentioned, those 3 or 4 cities, pockets where the real estate prices are falling. But just the opposite is true in other cities where real estate prices are remaining strong and actually can go up. That has to do with price. That has to do with the economy locally. Like, for instance, in Silicon Valley, it's going to be different than in the Rust Belt. It just is. It's just real estate is a very localized thing. They say all politics is local. Well, all real estate is local. You can't go national on anything unless you're doing a very generalized term. So let me do a generalized term. The guess or the prediction for this year in terms of nationally what prices are going to do, down by 4%. Now, that doesn't seem like a lot, right? No, it doesn't. Now, there are some who disagree with that. Goldman Sachs came out in projection of 6% lessening. But if you look over the last 3 years where real estate nationally has gone up about 30 to 35%, it's still a pretty big win, which is why if you're in the real estate market right now and you're looking to buy something, the key here is prices aren't rising fast or they're actually going down in some markets, and your mortgage rate, the rate you're going to get on a 30-year fixed rate A-paper loan went from 7.5%, it's now 6%. That's a pretty big drop. We may even see it drop even further this year. We have some predictions that 5.2% is what it's going to be at the end of 2023. Now, all things being equal, this is why people are saying, oh yeah, first-time buyers, they're going to come back to the market. Why is that? Because they feel that this is the best time and the best way by which they can get into the money. And getting into the money means buying a house. Because if anything, I'm a perfect example. In 1995, bought a house. It's gone up 5 times since then. 5 times. Now, granted, I've been in that house, raised my kids there, and have paid the house off. So now we're looking at a huge windfall in terms of property value. Now, obviously, you're not spending that money, but still, it's pretty amazing. So if you want to get into that, this is why they say now's a good time for first-time home buyers to get into the marketplace. Okay, Top of the Mind podcast. Great podcast. Housing Wire saw it. Guy named Mike Simpson puts it on. Brought on today Clayton Collins, CEO of HW Housing Wire Media, and is just purchased by Housing Wire. He generalizes a lot of things, and I like that. And rather than go from one year to the next year and predictions and everything we started off the show with earlier today, talking about what your New Year's resolutions would be, no, he talks about cycles and what happens. We've been through a number of these down cycles, and I would say right now in real estate we're in a down cycle. The reason being is that very few product is on the market. We see prices rising, and the mortgage interest rates are still pretty high, so people who are interested in trying to get into the market, they think once, they think twice. Sentiment is a big deal. But the cycles that this goes through, as I've been in the real estate business 30 years, we've probably been through 4, 5, maybe 6 of these. Everybody knows about the big one in 08. This one, absolutely. But there were several more before that. There was the dot-com bubble in the early 2000s and a couple other smaller ones. But this gentleman says interest rates 6%, sellers not accepting the offers or not accepting that their particular price for their house should be lowered. Usually takes 6-7 months before that happens. Before they see, the for sale sign get rust on it or have leaves fall on it or be kicked over by the neighborhood dog. Yeah, that's when sellers actually lower their prices. Rates to be 5s. I said this earlier, about 5.2% is the prediction. He also says it here. Clayton Collins does. Okay. There's a sentiment out there that only doom can bring the rates down, which is why the Fed was raising the rates so aggressively, right? We saw rates go up. We saw mortgage rates go up. We saw inventory go down. We saw prices pretty much stay the same because there's nothing else to buy, so you're not going to lower your rate. So if we come out with higher and higher interest rates by the Fed, That's a doomed scenario. And that scenario is being what's pushed by the Fed to say, hey, we also have to have high unemployment. High unemployment, high interest rates, that's what we're going to do in order to have inflation come down. Well, there's a whole sentiment out there, and this guy also agrees with it, that says, no, that's not true. We're going to have what they call a soft landing here. We're going to have employment, low unemployment. It's not going to go up. We don't need to fire 1 million people, 1.5 million people, in order to get inflation under control. What we need to do is continue to stay the course, keep raising the interest rates, and we're already seeing inflation come down. That's the key to this thing. Inflation has already come down. If you take housing out of the mix, we're very, very close to where we need to be. If we've come down 4 percentage points over the last 6 months, we're probably going to do the same in the next 6 months, which means that 9.5% inflation rate that we were is going to be closer to 2%, which is where the Fed wants it to be. And that could happen more quickly than not. I don't know if I agree with all of it, but that's what this guy says on the Top of the Mind podcast. Mike Simpson, he is the host for that particular podcast. Let's see. Is there anything more? Nope, we're up against it. I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening to the show as always, and we're always here. You can always join me on YouTube as well. Jeff Barton, the Mortgage Voice. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
News, weather, and talk from KCAA, broadcasting to the Moreno Valley, Corona, and Riverside.
Tahibo Tea Club's original Pure Pau Arco Super Tea comes from the only tree in the world that fungus does not grow on. As a result, it naturally has antifungal, anti-infection, antiviral, antibacterial, anti-inflammation, and anti-parasite properties. So the tea is great for healthy people because it helps build the immune system, and it can truly be miraculous for someone fighting a potentially life-threatening disease due to an infection, diabetes, or cancer. The tea is also organic and naturally caffeine-free. A 1-pound package of tea is $49.95, which includes shipping. To order, please visit TahiboTeaClub.com. Tahibo is spelled T like Tom, A-H-E-E-B like boy, O, then continue with the word tea and then the word club. The complete website is TahiboTeaClub.com or call us at 818-610-8088, Monday through Saturday, 9 a.m. to 5 p.m. California time. That's 818-610-8088, TahiboTeaClub.com.
What does the WeatherBug app tell you?
My commute will be a doozy today.
Pack my allergy meds.
Lightning. Pick up a pizza, not a tennis racket.
With more free map layers than any other weather app, WeatherBug tells you more of what you need to know to prepare you for the unpredictable. Discover why over 10 million users choose WeatherBug.
Maybe it's a commute to the couch day.
Download the WeatherBug app today for free.
This segment is sponsored by PressPrint, Southern California's best full-service union printer and mail house. They offer the lowest prices around with unmatched service and reliability and free delivery throughout SoCal. PressPrint can print anything from letterhead, business cards, and campaign literature to mailers of any size, lawn signs, banners, door hangers, or just about anything you might want. PressPrint promises to save money for you, your business, or your campaign. If you'd like to learn more, contact Mike Kroonbrand at PressPrint 714-399-8708. Get the union bug. Car Recycling in Fontana reminds all drivers when you take to the road, remember those 3 C's of safety. That's caution, courtesy, and above all, a little common sense. Safe and sober driving is everyone's responsibility. This message courtesy of Car Recycling at 3800 East Andy Devine in Kingman. Call Car Recycling at 928-757-9888. That's 928-757-9888. That's where Trish and the staff are wishing everyone happy and safe driving.
You've eaten lots of great food and not so great food at restaurants. Cowboy Burgers in Fontana and now on Arlington and Riverside will fast become one of your favorites with their delicious, mouth-watering burgers and breakfast burritos. Cowboy Burgers and Barbecue also serves fantastic smoked barbecue baby back ribs, tri-tip, chicken, pulled pork sandwiches, as well as lunch and dinner plates. Everything is made from scratch, including their delicious side dishes like coleslaw, potato salad, barbecue beans, and much, much more. Check out their rich, decadent chocolate brownies.
Hi, I'm food critic Alan Borgen. and you can dine in, take food out, or have them cater your next special event. I highly recommend Cowboy Burgers and Barbecue at their new location at 5573 Arlington Avenue in Riverside. Just look them up on the internet. That's Cowboy Burgers and Barbecue. Happy eating!
And perfect for the holidays, Cowboy Burgers and Barbecue is also available for catering. That's Cowboy Burgers and Barbecue in Fontana and now in Riverside on Arlington.
Learn to make money 5 ways with rental real estate. Double your money with apartments. And get your map to financial freedom. And that map starts with a free workshop. Sign up now at lifestylesunlimited.com. Click on the Join Free Workshop tab and attend online or in person. That's lifestylesunlimited.com. lifestylesunlimited.com. Again, that's lifestylesunlimited.com.